The stock market might seem like a daunting labyrinth, but at its heart, it's a platform for buying and selling pieces of companies, called stocks. These stocks represent ownership in the company. When you buy a stock, you're essentially buying a tiny slice of that company, hoping it will grow and become more valuable over time. Think of it like this. Imagine your favorite bakery decides to expand. They need capital, so they offer shares to the public. You, believing in their delicious potential, buy some shares. As the bakery flourishes, your shares become more valuable, reflecting the bakery's growth. This continuous dance of buying and selling determines the price of a stock. If more people want to buy a stock, demand, then sell it, supply, the price goes up. Conversely, if more people are selling than buying, the price falls. Understanding this fundamental principle of supply and demand is key to navigating the stock market. It's a simple concept, yet it underpins the entire system. Remember, buying low and selling high is the name of the game, but timing the market perfectly is more challenging than it seems. The stock market is like a living organism, constantly reacting to the world around it. News events, economic reports, and even political changes can send ripples or sometimes tidal waves through the market, impacting stock prices significantly. Imagine waking up to news that a major tech company just released a revolutionary product. Investors, excited about the potential profits, rush to buy the company's stock, driving its price up. This is how news events can directly impact individual stocks. On a broader scale, economic indicators like interest rate changes or inflation reports can influence the entire market. Positive economic news generally boosts investor confidence, leading to a market upswing, while negative news can spark fear and trigger a decline. Understanding how to interpret news and its potential impact on the market is crucial for investors. Staying informed and discerning reliable sources from noise is essential for making sound investment decisions. Navigating the stock market doesn't require a degree in finance, but it does demand a willingness to learn. Luckily, we live in an age where knowledge is readily available. Numerous resources can help demystify the complexities of the market. Start with the basics. Understand fundamental concepts like market orders, limit orders, and different types of investment accounts. Familiarize yourself with common financial jargon. The more you understand, the more confident you'll become. Online courses and tutorials offer structured learning paths for beginners. Websites like Investopedia and Khan Academy provide free resources, while platforms like Coursera and edX offer more in-depth paid courses. Books remain a valuable source of knowledge. Classics like The Intelligent Investor by Benjamin Graham and my own A Random Walk Down Wall Street offer timeless insights into market dynamics and investment strategies. The stock market isn't confined by geographical boundaries. It's a global network of interconnected exchanges, each reflecting the economic pulse of its region. Understanding key global indices provides a broader perspective on market movements. The S&P 500, a prominent index in the United States, tracks the performance of 500 large-cap U.S. companies. It's considered a benchmark for the overall health of the U.S. stock market. Across the Pacific, the Nikkei 225, composed of 225 large, publicly owned Japanese companies, serves as a barometer for the Japanese economy. Similarly, the FTSE 100, representing the 100 largest companies on the London Stock Exchange, reflects the United Kingdom's economic climate. These indices, among others, provide insights into the global economic landscape. While they shouldn't dictate your investment decisions, they offer valuable context and can help identify potential investment opportunities across different regions. Section 5. Investing wisely. Investing in the stock market can be a rewarding endeavor, but it's essential to approach it with a healthy dose of caution and a well-thought-out strategy. Remember, the market is unpredictable, and no one has a crystal ball. Before investing a single dollar, define your financial goals. Are you saving for retirement, a down payment on a house, or your child's education? Your investment timeline and risk tolerance should align with your financial objectives. Once you have a clear goal in mind, research and select investments that fit your strategy. Don't fall for get-rich-quick schemes or blindly follow the crowd. Patience and discipline are your allies in the market. Remember, investing is a marathon, not a sprint. Don't panic sell when the market dips. Instead, view these dips as potential buying opportunities. Stay the course, remain focused on your long-term goals, and never invest more than you can afford to lose. Section 6. Understanding market trends. Imagine the stock market as a vast ocean, constantly ebbing and flowing. Like ocean currents, market trends dictate the general direction of the market. These trends can be upward, downward, or sideways, each influencing investment strategies. An upward trend, often called a bull market, signifies optimism and growth. Stock prices generally rise during this period, creating opportunities for investors to buy low and sell high. Conversely, a downward trend, known as a bear market, reflects pessimism and economic downturn. Stock prices tend to fall, making it a risky time to invest unless you're looking for bargains with long-term potential. Sideways trends, also called consolidation periods, represent a state of uncertainty. The market might fluctuate within a narrow range, making it difficult to discern a clear direction. This period often presents a time for reflection and reassessment of investment strategies. Recognizing these trends is crucial for investors. While predicting the market's every move is impossible, understanding these broader patterns can help inform your investment decisions. At the heart of the stock market's price fluctuations lies the fundamental principle of supply and demand. Just like any other commodity, the price of a stock is determined by the balance between how many people want to buy it and how many are willing to sell. When demand for a stock exceeds supply, its price goes up. Think of it like a popular toy during the holiday season. Everyone wants it, but there are only so many available, driving up the price. Conversely, when supply outweighs demand, the price drops. Imagine a store having a clearance sale on last season's clothing. The supply is high, but the demand is low, leading to discounted prices. This delicate dance between supply and demand is influenced by various factors, including company performance, industry trends, economic outlook, and even investor sentiment. Understanding this interplay is fundamental to grasping how stock prices are determined. Investing in the stock market involves an inherent trade-off risk versus return. The potential for higher returns usually comes with higher risk, and vice versa. Finding the right balance is crucial for successful investing. Risk refers to the possibility of losing some or all of your investment. Stocks are considered riskier than bonds, but offer the potential for higher returns. Understanding your risk tolerance is essential before making any investment decisions. Return, on the other hand, represents the profit you make on your investment. It can come in the form of dividends, which are payments made by companies to their shareholders, or capital gains, which is the profit you earn from selling a stock at a higher price than you bought it. The key is to find investments that align with your risk tolerance and return expectations. If you're risk-averse, consider investing in more stable, established companies. If you're comfortable with higher risk, exploring emerging markets or growth stocks might be suitable. Imagine putting all your eggs in one basket. If you drop the basket, you risk breaking all your eggs. The same principle applies to investing. Diversification is a risk management strategy that involves spreading your investments across different asset classes, industries, and geographical regions. By diversifying your portfolio, you're essentially reducing the impact of any single investment on your overall returns. If one stock or sector performs poorly, others might compensate, cushioning the blow. Think of it like building a well-balanced meal. You wouldn't want to eat only one type of food, would you? Similarly, a diversified portfolio should include a mix of stocks, bonds, real estate, and other assets, each playing a specific role in your overall investment strategy. Diversification is not about eliminating risk entirely, but rather managing it effectively. It's a fundamental principle that can help protect your investments and potentially enhance your returns over the long term. The world of finance is constantly evolving, with new trends, technologies, and investment opportunities emerging regularly. To thrive in this dynamic landscape, continuous learning is not just beneficial, it's essential. Think of it like tending to a garden. You wouldn't plant seeds and then simply wait for them to grow without any further care, would you? Similarly, your investment knowledge requires constant nurturing and expansion. Stay updated on market trends, economic indicators, and industry news. Read books, follow reputable financial publications, and consider attending seminars or webinars. The more you learn, the better equipped you'll be to make informed investment decisions. Remember, investing is a journey, not a destination. Embrace the learning process, stay curious, and never stop seeking knowledge. Your future self will thank you for it.